Staring at a price chart can sometimes feel like you're trying to read a foreign language in the middle of a storm. It's just this chaotic jumble of lines, right? But what if I told you there's a tool that can cut through all that noise and translate it into a clear story? Well, that tool is the moving average, and it's a surprisingly simple but incredibly powerful way to spot those high-probability trading opportunities. All right, so here's our game plan for this explainer. First, we're going to tackle that core problem, how to see the real trend through all the noise. Then I'll introduce you to our secret weapon, the moving average. From there, we'll build a classic beginner's trading system, show you its fatal flaw, and then we'll level it up into a more disciplined and finally a pro-level strategy that really gives you the best of both worlds.
Okay, so let's dive right in with the fundamental challenge that really every single trader faces. It's not just about watching prices bounce up and down, right? It's about cutting through all that daily noise to figure out what story the market is actually telling. Are we in a powerful uptrend, a slow decline, or are we just drifting sideways?
So take a look at this. This is a daily price chart for corn, and it's completely naked. No indicators, nothing. Just raw price action. And what do you see? You've got sharp spikes, sudden drops, and these long periods where it just seems to go absolutely nowhere. It is pure market chaos, and honestly, trying to make sense of this can feel pretty overwhelming.
So I have to ask you, looking at this, could you confidently place a trade? Is the real underlying trend pointing up, down, or is it just stuck going sideways? It's almost impossible to say for sure, isn't it? And trading on raw data like this, well, it's like trying to navigate through a dense fog. And that is the exact problem we're here to solve today. So to cut through that fog, we're going to need a special kind of lens, a tool that's designed specifically to smooth out all that chaos and show us what's really going on underneath. It's time to meet the moving average. Now, at its core, this concept is incredibly simple. A moving average is, well, it's just the average price of something over a specific number of days or hours or whatever you set it to. Its entire job is to filter out all that random day-to-day noise and smooth out the price action so we can finally see the real underlying trend. Now, you're going to run into a few different types out there. The most common are simple, exponential, and weighted. The last two just give a little more importance to the most recent prices, which makes them react a bit faster. And look, while those little details can matter for some really advanced strategies, the basic idea behind them is exactly the same, and honestly, the difference on the chart is often pretty subtle. In fact, Jeffrey Kennedy, the author of our source material, really puts it perfectly. He says, I rely mostly on the simple moving average because simple things usually work best. And I couldn't agree more. So for the rest of our time here, we're just going to stick with the simple moving average, or SMA. Okay, foundation set. Now let's build our first system. The place where most traders start when they learn about moving averages is a really popular strategy called the dual moving average crossover. Here's how it works. You take two averages, one fast one, let's say a 5-day, and one slower one, maybe a 10-day. The logic is just beautiful in its simplicity. When that fast line crosses above the slow one, that's your buy signal. When it crosses below, that's your sell signal. And you can see in a market with a strong trend, the signals it spits out look almost perfect. It seems almost too easy. And of course, whenever something in trading looks that easy, you know there's a catch. This simple, effective-looking system has a pretty big hidden flaw. And that flaw has a name, whipsaws. This is the #1 problem that absolutely plagues these simple crossover systems. So to understand why this happens, you have to get this one core concept down. Moving averages don't predict the future. They confirm the past. Seriously, think of them like looking in your car's rearview mirror. They're what we call lagging indicators, meaning they are always reacting to what has already happened. Now, when you're in a strong trend, that little bit of lag is totally fine. But when the market starts moving sideways with no clear direction, that's when the whole system just falls apart. Look inside this circled area here. You can see the damage. You get a buy signal, then a sell signal, then another buy, then another sell, and each one is just a small, frustrating loss. The system is just chopping you up. That is a whipsaw. And this is why just endlessly tweaking the numbers on your averages, trying a 9-day and a 21-day or whatever, isn't the answer. Like the source material says, there is no single magic setting that works across all markets and all timeframes. It just doesn't exist. We need a smarter, more disciplined approach. So if fiddling with the numbers isn't the right move, what is? Well, we need a more robust system. And the author's preferred solution is something called a moving average price channel. Okay, this system completely changes the game. Instead of just looking for two lines to cross, we create a channel. The top line is a moving average of the recent price highs, and the bottom line is an average of the recent price lows. So now a trade signal only happens when the price makes a really decisive move and breaks completely outside of this entire channel. So what this does, essentially, is create a neutral zone or a buffer. Price now has to clear a much higher bar. It has to make a truly significant move before it can trigger a signal. And this design is fantastic because it effectively filters out all that minor, choppy market noise that caused all those painful whipsaws we saw earlier. All right, so let's recap. We've seen a fast system that unfortunately gives a lot of false signals. And we've seen a slower, more disciplined system that filters them out. So the big question is, what if we could combine them to get the absolute best of both worlds? Yeah, let's put these two systems side by side for a second. The crossover system, it's fast. That's great for getting out quickly and locking in profits. But it's also kind of reckless, right? It lures you into a lot of bad trades. Then you've got the price channel system. It's disciplined, which is great for filtering out those bad entries. But it can be a little too cautious, sometimes making you late to the party and slow to leave. And this is the pro-level synthesis. Here's the magic. We use the disciplined price channel system for our entry signal. This keeps us safely on the sidelines when the market is a choppy mess. But once we're in a winning trade, we switch to the fast crossover system for our exit signal. This lets us get out quickly and protect our profits. It's a slow in, fast out methodology, and it really is the best of both worlds. And look, this isn't just some abstract theory. If you watch financial news, you're going to hear specific moving averages mentioned all the time. Stock traders, they live and die by the 50 and 200-day averages. Commodity traders often focus on shorter ones, like the 10 and 40-day. And in a way, these become self-fulfilling prophecies, because millions of traders are all watching and reacting to the very same lines. So how can you take all this and apply it yourself? Well, to build your own robust system, the source material lays out a simple 4-step plan. Step 1, identify your market and time frame. Step 2, test your strategy over a long period that has both strong trends and those messy sideways phases. 3, tweak and optimize your settings to find what works best. And finally, and this part is absolutely critical, you have to test it again on a completely different set of data to make sure your results weren't just a lucky fluke. So the big takeaway here is that you've moved way beyond just staring at a chaotic chart. You now have the actual building blocks to create a disciplined, rules-based trading system that can help you find those high-probability opportunities. You have the tools now. The only question left is, which market are you going to test them on first?